Okay, I'm all set. You had a question? Practice my names. Teach me how to say it. Sagandika. Did I say it right? Okay, I'll try to remember that. Sagandika. Nice to meet you. I can call you Sam. Okay. So you are a fall 2023 graduate. Okay. Thank you for this. Ruth? Is that right? Try it. Let me get it. So you are fall 2023 graduate also, is that right?
Spring.
Springs. So you're considering a career with the Chamber of Commerce. I know some people over there. I know over there. It's been a while since I connected. Have you looked into their Centurions program?
No.
Check it out. It's just like it sounds, Centurions. It's a leadership program for young professionals around town. And they have it set up to take certain field trips all over the globe and network with other prominent business leaders. It's a really good setup. Thomas. Yeah, okay. Just practice. You give me the whole semester. I might get there. You're May 2023, corporate finance. What's the desired career path after that?
Something in FP&A maybe.
Okay. That's where I started. I was working for Sprint at one point in time, which half the town worked for Sprint.
I did make one, but it's not a colored picture.
Oh, man, that's
So I can bring one next time.
not help me out. Yeah, give me that thing and I will try my best. Yeah,
There, so.
you want to swap it out for a colored picture at some point in the future. That'd be great. Okay, teach me how to say it, Manette. Manette. Okay, it's all right, Manette. Okay, I will try. Yeah, nice to meet you, Manette. You do CrossFit.
I
Yeah.
still do.
Yeah, I'm trying to learn how to do a pistol squat. Can you do a pistol squat?
I'm still trying.
Yeah.
That is only starting.
So from what I understand about pistol squats is a big component of it is ankle flexibility.
Yeah.
I think that's where I go. I think that's what gets me. That's about how much I got.
I don't know why you would want to do one of those.
I don't know. I don't know either. I just saw somebody else do it. I'm like, I'm gonna try that. It didn't work out too well for me. So Brett, you're on the portfolio manager track. That was the same track I was on. You have the same time horizon I was on. All right, I'm gonna put myself to work as an analyst. And for me, that was the Buffalo funds. And then I figured it would take about 10 years to work my way up into a portfolio manager's job, maybe 5. But then that still leaves 5 to establish yourself with any kind of track record. So,
Right.
so it's a 10-year plan. And I hired a career coach because I was thinking about going out and doing something on my own. And I told him my plan and he laughed at me. That's ridiculous. Either you're good enough to start your own business or you're not. So he kind of systematically walked me down this conversation where I was forced to acknowledge that, okay, I probably have the resources just to go now. I don't need a 10-year plan. It's a big risk, but
Sure.
let's take it. So I owe a lot of my career to that gentleman who talked me through all my head trash.
When did you get your CFA? Is that 2 years into your?
Oh, yeah. I graduated from undergrad. I worked for Sprint doing mergers and acquisitions. Studied my MBA and took that CFA curriculum at the same time. So it would have been like 2 years out of undergrad. I got the CFA and MBA and began to navigate from there.
Sure.
Perfect timing. I'm up here practicing right now. Okay, teach me how to say your name. Akil?
Yeah,
Akil, nice to meet you.
yeah, next to
And you're from India. How do you say that hometown name?
Hyderabad.
Hyderabad?
Yeah.
Okay. What's the church to bar ratio in Hyderabad? No churches or no bars? I mean, what's the ratio? More churches or more bars in Hyderabad?
Regarding
Probably more churches then.
Yeah.
Okay. That's the way I grew up too. You received the award for excellence in financial accounting. Well, come on up. You might give a more interesting talk than I do. I'm just joking. I'm just joking. I like your style.
Thank you.
Thank you. Okay, your preferred name is Stella? Okay, nice to meet you, Stella. I pronounce this Shingles. I'm gonna call you Stella, that's your preferred name. Nice to meet you. Yeah. Got pretty bad or?
The first day, I got hit hard. I got 102 pounds. I had no body ache. After I got stuck in like the Tylenol.
Yes.
Okay.
Last week.
Yeah, I was like, I called As soon as so that Tuesday, I had body aches and so, like I did much of it. I don't like that.
We're working at an investment company in Washington. Which one?
Didn't have.
It's called Broco Investments, brothers company.
Okay.
So they focused in time agriculture.
Finally, like.
Oh, right on. It's hot space.
Yeah, especially out
I
there.
was like,
So
oh, all right, I'll take it.
we
I didn't feel. hot.
managed a
Okay, let's see, 102.
when riding the Apple Valley as well. So north of Wenatchee, Washington, so central.
I don't know Washington very well, but
Well,
Seattle once, if that.
oh man, I've been there. It was all over the state.
People live still, I heard like it's.
Driving.
I thought I'd take COVID. Do that.
Okay, it's 5:30. I have one person logged in through Zoom. Vicky, can you hear me?
Yes, I can.
Okay, so. In the chat. And test. Okay, we're set up on our end, Vicky, so I'm gonna go for it. Yes, you can. Okay, great. Okay, welcome. This is what I refer to as the brain pollution lecture, because I've already booted up the first exam for the semester, and this material is not covered on that exam. So anything that we talked about tonight will be on the second exam. Anybody logged in hey, Vicky, will you put yourself on mute? I got a little bit of feedback here. You are on mute. What's going on? Oh, okay. So I opened that first exam. Anybody go out there to see, take it? Anybody take it already? One. Okay, how'd it go? Just not, you don't need to comment on your score or anything, just ease of access, user kind of.
It was okay. It's not a formalized use.
Okay, well, don't tell anybody else what's on the exam. Then you blow the curve, Ruth. So there's some formulas on the exam. Okay, log into I had one email, somebody emailed me today, I forget who it was. The exam's on my business course website. So you go out there, it's in the 4th module, click on that. You have 2 hours to take the exam. I think it's 40 multiple choice questions. And the exam window will be open until this time next week, I believe. I sent it out via email, so check your email for the exact time. And make sure you have it taken, all the way taken and submitted by that time, or you're gonna get cut off and you're not gonna be able to submit the exam and you won't get any points. Questions about how that works? Okay, then I'm just gonna open it up to other questions in general about the homework or the research project or anything. Somebody had a question before class?
No, be done.
No, oh, you got your question answered? Okay, no problem. Okay, well, tonight, my plan is to talk about revenue recognition and operating income. There aren't any concepts in module 5 that I expect to be new to this class. Most of these will have been covered in your accounting prerequisites. We're gonna go a little bit deeper. And I want you all again to filter this content through the mindset of, if you were so inclined, how would you manipulate this account? because there are estimates that we're gonna need to make, and there are different accounting treatments when it comes to recognizing revenue that we're called upon to put into place as management teams, and they have different effects on the accounting. So if you all know what your executive teams are linked to, whether that's earnings per share or revenue growth or what their pay packages are, think about how they would enrich themselves with this accounting. So when we get to talking about revenue recognition, one of the first challenges when it comes to your semester research project is to find out how your company gets paid. So Matt, you're on the top of the pile here. Who'd you pick to do your research project on?
Lockheed Martin.
So when you go to Lockheed Martin's 10K, they're gonna have a big section called revenue recognition policies. And it's dense reading and it can be pretty technical and sophisticated. Pour through that. They're all gonna be different. Every business in here has accounting, collections, receivables, revenue, just product issues that are specific to Lockheed Martin or Starbucks. I mean, it's pretty obvious that Lockheed Martin is going to have a different revenue recognition policy than Starbucks. Starbucks is probably one of the simplest models that you can imagine. Lockheed Martin may spend years building, do they still build submarines? That's Northrop Grumman, I'm thinking of. Lockheed Martin has the contract for the F-35, which probably takes, that's probably a multi-year
Yeah.
contract.
They just extended it 10 years out.
So we're gonna talk about that tonight. What if you're one of these companies that has a long-lived construction project like nuclear power? We don't build much nuclear anymore, but it used to be the case that if you hired a Jacobs Engineering or a Foster Wheeler to build a nuclear power plant, that contract might last 5 years. So you can't make use out of financial statements that show zero revenue for 5 years and then a huge chunk lands in 1 year. So we have accounting policies for that. We have revenue recognition policies for that. And they kind of span the gamut of what you might think of as reasonable, but there's some fudge factor in there. There's some opportunity for gamesmanship. So your first job is to open up the 10K and find out what the revenue recognition policy is for the company that you're working on. Our authors are going to walk us through Pfizer here, and you can see Pfizer reported, what was on that last slide, $53 billion worth of revenue in 18. So sizable chunk. That was a couple of years before the pandemic. I wonder what the pandemic did to their revenues. These last 3 bullets on this screen are the technical criteria for when we recognize revenue. It probably sounds familiar to everybody in the room. We're going to recognize revenue when these criteria are met. So the good or service has to have transferred. We don't recognize that revenue when somebody buys something on layaway. Am I dating myself with the term layaway? Anybody ever bought anything on layaway? No. Well, used to be you could walk into Sears and take a toolbox or a pair of jeans and take it up to the counter, and they'd take that good and they'd put it in the back room and then put your name on it. But you couldn't have it until you actually had the cash, brought in the cash to pay for it. It was just kind of reserved. There was a holding place. It was called layaway. That doesn't happen anymore, but in that instance, the good has not transferred to the purchaser, so the company can't book revenue. Same way with the service. Second criteria is when the customer obtains control of the good or service. So there are other instances when, say you take a truck out on a test drive. You haven't really purchased that truck yet because you don't own it. You don't have full control of that. That still belongs to the dealership. There are other instances, and this is why I tell you all to check your own specific revenue recognition policies, where that control might transfer over time. If it's a music license or a patent or some other intangible good that might transfer over a period of time, in which case you might reasonably expect for that revenue to be recognized over that period of time. And then lastly, it's not necessary to receive the cash to recognize revenue. And we'll go through a segment of module 5 tonight, talking about accounts receivable and how we need to accommodate goods sold on credit. And that trips a lot of students up when it comes to revenue recognition policies, because sales can be significant without any cash coming in. And that can be a big problem for some businesses when we start to look at cash flow. If sales spike, but most of those sales are on credit, that might not necessarily even be a good thing for the business, because they need the cash to come in to service some of those goods, to service some of those services that they might be delivering to the public. We're going to monitor some key ratios that give us some health checks on the status of the business over time. Make sure that they actually have the cash to make their business function. That I want you to go searching for. This is Pfizer's 10K. And in this language, we're talking about recognizing revenue. Let's see if I can get that on the screen. In this instance, we're talking about recognizing revenue net of chargebacks. So such variable consideration represents chargebacks, rebates, sales allowances, and sales returns. FASB dictates that if we sell something and we know a percentage of that is going to be returned through just sales returns, allowances, I don't like this, I want to take it back. I'm a runner. Next week, I'm going to go to London and I'm going to run the London Marathon. Well, ever since COVID, Nike has had some of the most generous return policies that they've ever had. Now, runners can buy the most high-tech Nike shoe. Did anybody see Kipchoge break the marathon world record yesterday? So I broke it by 30 seconds, really something pretty cool. They broke it with these high-tech Nike shoes. Nike put like $2 million into the development of these shoes just for the purpose of breaking the marathon world record, and he went out and did it. So now everybody in the world wants a pair of these shoes. Well, Nike's return policy now is that I can buy a pair of shoes, I can go run in them for 30 days, and if I don't like them, I can send them back. No charge. What's that do to their revenue? I haven't looked at Nike specifically. Anybody pick Nike in here to do their project on? Okay, no, you're doing Nike? Oh, okay, never mind then. Well, my expectation would be that they have a big line item on their income statement for sales returns and allowances. What sales returns and allowances were before COVID, this is a COVID policy, is a fraction of what they have to be today. These are more generous policies than they've ever had in the history of Nike. So their revenues aren't necessarily as high quality as they have been in prior years. Those are the types of things that you need to be looking for as an analyst. You need to understand the go-to-market strategies of the companies that you're working on so you can make adjustments for the accounting that they have in their books. So how would you game that if you were Nike? And this is really anybody. If it's your job to record revenues on your income statement, but it's your job to record them net of an allowance account. So you have gross revenues, and then you have net. So you're subtracting off a reserve that we're going to book for sales returns and allowances. And, in plain speak, that's just how many shoes do we think are going to be returned? And then we have net sales. So that net sales number is what we're really after. How do you gamify that? How do you manipulate that if you're so inclined? Anytime you hear me say guesstimate, estimate, accounting treatment, well, where does that come from? How does Nike know how many shoes are going to be returned? Historical average. Can Nike predict the future? No. So they don't know. They can use a historical average. So if they use a historical average, based on the conversation we just had, we know that's gonna be understated. So if they understate sales returns and allowances, what's that do to net revenue? Well, if they understate the return number, it's gonna increase the revenue number. So if the historical average of shoes being returned was 100, and we think it'll probably be 1,000 today, then they plug in 100 because they're using a historical average, then their net revenue number is gonna be a lot higher than what it probably should be, given how generous their return policies are.
Compare with the recent years.
But my point is, hold on, my point is, that would be an entirely reasonable thing to do. Nike's executive team could argue, oh, well, our historical average return has been this. We're gonna use that to estimate. And what happens to their earnings per share that year?
Increases.
It increases, right? Which is exactly the kind of thing that you wanna do if you're the retiring CEO. Because this is the last year you're gonna get paid, right? You need to cash in on your bonus package this year. So you manipulate this, say, well, sales returns and allowances, we're gonna manipulate that line. Not only that, but you probably jacked up your gross return, right? You took your gross sales and you magnified them because now you have such a generous sales returns and allowances policy that you're getting all these runners like me, like, yeah, as a matter of fact, send me 3 pairs of shoes and I'll try them all out and send 2 back. So now the top line sales number goes way up. The sales returns and allowance line is understated. It flows all the way through the income statement and trickles down to your earnings per share. And you look great until you don't, which is next year when all the shoes come back. Maybe not next year, maybe it's 30 days, but these things have a lag and it's pretty easy to influence the accounting for something. So what our authors are pointing out here with this little snippet of Pfizer's 10K, this is where it's disclosed, but they disclose it in the driest, most technical, most painful to read language that you will ever find anywhere. Which is why analysts that are good get paid really, really well. Because they have to read this and then they have to interpret this and then they have to think with the wherewithal to say, okay, what's going on in that company's business model and how might this be? And that's not always easy because this isn't the only line that they might be playing around with. There's another 50 to 100 that we're going to be touching on in this semester, and this theme might get a little old by the time we're done with this class. This is a great slide. Star this one, be a good exam question. Complications of revenue recognition. These are all the little nuances and subtleties that you have to be aware of as an analyst. Non-refundable upfront fees. So we recognize revenue when the good or services are provided. Bill and hold arrangements, that's like layaway, consignment sales, licenses, franchises, variable consideration. They're all just a little bit different and they're all gonna have their unique revenue recognition policies that are disclosed in the 10K. So we won't look at licenses and go into a deep study of the accounting for licenses because it varies. What you need to have a good grasp on is, okay, what's a license? What's the term? Usually when you buy a license, there's a term associated with it. That might be a year or 2 or 10. Spotify is probably a good example of this. They rent licenses for music, or they buy licenses for music. That usually gives them the right to that music for a term. And if it's a 5-year term, it's pretty common revenue recognition policy for that revenue to be recognized in equal installments over the term of the license. So there's a common sense aspect to how these things typically unfold. So just be on the lookout for that. More complications include multiple elements to the contract. Trying to think of a good example here. Construction's probably the best example that I can think of. Oftentimes when you have a big construction project, you'll have different milestones. Once they're met, the cash transfers. It's often, oftentimes you see revenue recognition policies linked to those performance milestones. You might be on the lookout for that. Right of return, gift cards. So here's some of the accounting, and the accounting's flexible. This is an example of performance obligations that are satisfied over time. And the authors give us a pretty simple example here. We're going to recognize the revenue associated with the total block of business in proportion to the costs that are incurred. So that would be the first bullet point there. We're going to recognize revenue as a proportion of total costs incurred. So if we incur 15% of the costs, in this example, we're going to recognize 15% of the revenues. And this is some of the fine print that you might see there, but let's look at. Here's the math. So we're going to take year one, we incur $4.5 million of total cost. 4.5 million is 60% of the 7.5 million that we expect to be incurred over the life of the project. 60% times the $10 million revenue gets us 6 million that we're going to recognize in year one. And the math for year two becomes pretty simple. We're going to recognize the remaining bit in year two. That's called the cost to cost method. So it's likely that you'll have an equation on the exam that deals with that, the same way for the homework. Now, when you get into the actual accounting, it's going to look something like this. So always start with cash. When you go to do the debits and credits, it's helpful for accountants to start with the cash, because if you get cash going out the door, that's credit. If you got cash coming in the door, that's your debit. So start there. And if you have a credit like we do here, because we have expenses, we just identified $4.5 million worth of expenses. So that's credit to cash. Once we know that, we can go looking for the offsetting debit. And in this case, that offsetting debit is going to be cost of sales. 4.5 million of that is going to flow through to retained earnings. Now, the receivable is the 6 million accounts receivable. We have not collected that cash yet. We don't have cash associated with the receivable. We have cash associated with the expense because we spent that cash. We have not yet collected the receivable, so the debit's going to be a $6 million debit to accounts receivable with the offsetting credit to revenue, and that flows through to retained earnings. And then in the second year, you have the identical entries, just with different amounts. Here's some terminology. Contract assets. In the example that we just went through, the contract assets are costs incurred, but not yet billed. So we see inventories on here, contract assets on here. So you might see that as construction in progress. You might see that as construction assets. You might see that as contract assets. This is one of the challenges to this class. I get this question every semester. Students will be looking at the financials of the companies in the 10K, and there's no common nomenclature for a lot of these contract assets in this case. For the terms that are on the income statement, for the terms that are on the balance sheet, cash flow statement, really throughout the financials, there's no common nomenclature. So when you see something on the financials, you have to think to yourself, okay, well, I know that's an asset because it's in the asset section, but I don't have a good understanding of exactly what it represents. And then you got to go hunting in the fine print to understand exactly what that asset is. So it's just challenging. I don't know an easy way around it as an analyst. Again, that's why analysts make all the money that they make, because they have to go understand what these things are. And I'm certain that some companies make this more challenging than it has to be, with opaque and confusing naming conventions and financials that are purposefully hard to read. there's a great site. I forget the name of the lady that authored the site, and it was originally called footnoted.org. And I think they got bought, but if you go to footnoted.org, I think you can probably still find her. She wrote a book, it's terrific. Talks about a lot of the shenanigans that she uncovered over time, working as a financial analyst, and I think she became a short seller. So a short seller is a portfolio manager that makes a business out of betting against companies on the stock market. So it's a financial transaction where you will borrow shares, so you don't really buy them, you just borrow them, sell them, pocket the cash with the hopes that those shares will decline in the future, at which point you can buy them back. And now you just profited based on that spread between the time that you borrowed and paid back that loan. Well, she uncovered and got so good at uncovering corporate shenanigans, she learned which companies to bet against and launched her own short selling hedge fund. Did really, really well. One of the tips that she would recommend to all of her analysts, and I started to take her up on this, was that when you read a 10K, for the same reasons I'm just laying out there, that I am skeptical, and I think that some of these people who are up to no good purposefully obfuscate some of these terms. When you read a 10K, start from the back. Like, turn it over. Don't open it like a book. Turn it over. Read it right to left. Start with the last page in the 10K, because if there's anything they don't want you to find, it's going to be in the back of that book, in the very back of that book, in the fine print. They're legally required to disclose a lot. And what they're legally required to disclose is oftentimes what they don't want you to know. So how do you hide that? Well, you hide it with 50 pages of glossy color pictures at the front of the book that tell the story you want told and cast your company in the best possible light that you can cast your company. If you focus your time there, you're going to get distracted. That doesn't mean that a lot of companies that do this are great companies. They're well-run companies. They're to be commended for that. Good for them. But if you focus your time there, you're likely to miss any of the bad apples that are trying to hide something. So there's one little tip I picked up that served me well over time, because you get right into the sometimes what are the most juicy details of the 10K filing. Okay, let's talk about sales returns and allowances. Again, more terminology here. Our authors are introducing us to rights of return, sales discounts, retailer promotions. I mentioned the Nike thing. If you're doing, really it doesn't matter what company that you're working on, but especially if it's retail, you need to be mindful of any discounts or promotions that your company has, because you need to adjust the accounting for those. You need to make allowances for those so that we can present to the Wall Street community a number that is the best representation that we can possibly come up with of what our sales are going to be during that time period. Here's an example. Levi Strauss. Let's talk about blue jeans. Levi sells $130 pair of jeans on account. So if somebody buys these on credit. Of that 130, really, of all sales, we're just going to look at a single transaction that is for a pair of $130 jeans. Levi's expects 3% of all sales to be returned. So when we go to do the accounting for this, we want to show a sale of 130, but then we want to show a sales returns and allowances adjustment for 3%. And that math comes out to $3.90. So we're going to book a credit to sales returns and allowances and a debit for allowance for sales returns. And we're going to adjust our inventory for that. You can see that we're going to credit our inventory account for $240 and debit our cost of goods sold for $240. Math down here turns out to be a net sales number of $126.10 with a matching cost of goods sold of $77.60 and gross profit of $48.50. So that little That little piece of math right there multiplied times tens of thousands of jeans sold every day flows through to Levi Strauss's income statement and gives investors an idea of what they expect to sell for the entire period, which is shown here. Levi's typical disclosure. 16, 17, 18, they had sales returns and allowances of approximately 195, 211, and 245. So this table will always disclose where that account was at the beginning of the year, any additions the company made during the year, deductions, and an ending balance. Now, additions and deductions come with sales. So every time they sell a new pair of jeans, they have to add to that sales returns and allowance account because they know 3% of that is going to come back to them. And then when it actually does come back, they reverse that transaction. That's where the deductions come in. This fourth column over here is deductions. Those are actual returns. So we don't, once a good is returned, we don't need to reserve for a sales return or a sales allowance anymore. We just reverse that transaction. So you can track the flow of those transactions throughout the year with this disclosure in the back of the 10K. Find this disclosure. So here's, and we'll get into this a little bit more with ratio analysis, but I wanted to kind of give you a tip or a preview of what you need to be looking for. What can be a little pink flag or a red flag is when that 3% number. Levi's has been around for 150 years, maybe not quite that long time. They ought to have a pretty good handle on how many jeans are going to be returned. They've been doing this a long time. If it's been 3% for 100 years, and then all of a sudden this year it's 4%, that's a big problem. Now, tech company, somebody that doesn't have an established track record like Levi's, maybe they get a little bit more variability in that. But for Levi's, they should know what that is. So if they're not spot on, that should raise a little pink flag in your mind, thinking, what's going on here? Are they manipulating the numbers? Is something going on in the global markets? Are people not wearing jeans anymore? Is something seriously wrong with some of their manufacturing facilities? Did they just get rung up for using bad product or have a huge recall or something like that? So understand the trend in that data. And this is a recurring theme in this class. Every time we look at any ratio, and we'll look at some ratios here in a minute, that highlight the strength and quality of some of these numbers. Anytime we look at any ratio, I want you to look at it across time. So understand what it was last year and what it was 10 years ago so you can understand the trend. And then I want you to look at it relative to peers. So I need for you to understand why Levi's return might have a 3% return policy, 3% of their jeans returns. Whereas Gap has 1 or 2, or maybe it's 5 or 6 or 10. What is the competitive position between those two businesses? Why would they be different, if they even are different? And then dig into that reason why, and you'll really understand the competitive positioning of each of those companies. Okay, here's those ratios that will help us all ask those questions. And the 3 of them that the authors give us are presented on this slide. We're going to start with additions charged, that additions number that we just found in the disclosure table. Every one of the companies that you're looking at will have that disclosure table. So we want to look at the additions charged in a given period of time, and we want to divide that into gross sales. So you can see this is Levi's. In 16, they were at 10.3. In 17, they were at 10.1. And in 18, they were at 9.8. So what is that? That's less than 0.5% variability from one year to the next to the next. That's pretty good. So that doesn't That doesn't necessarily raise any red flags there, looking at those numbers. Then we look at the allowance account to gross sales. The allowances is what we estimate. So that was the 3% number. And there again, your ears should perk up when you hear that term estimate, because that comes from management, and anything that comes from management is manipulatable. Manipulatable. That's right, manipulatable. So they went from 2.8 to 3.3 to 2.8. Had a little bit of a spike in 2017. What would this do to earnings? It would decrease it. So what if this were the real number? What if you're the CEO and 2.8 is the real number, and you know it's gonna be 2.8. You're Levi, you know it's gonna be. But you book 3.3. And earnings go down. What happens next?
Retire.
Well, you can't retire this year. But if the number's 2.8 and you book 3.3, earnings are gonna be lower this year. But then not as many genes get returned as you expected. So those expenses that you put on your income statement, they don't actually happen. So when they don't happen, what do you think the accounting for that is?
Then recognize that the following year.
You'd recognize that the following year. So those entries would get reversed. You'd say to yourself, well, we didn't have the sales returns. So the expenses we thought were going to hit, they're not expenses. You got to reverse those out. So here's, if you're a Machiavellian skeptic like I am, here's how you game it. You want to gamify that. Like, okay, well, if you're the CEO and you're retiring in 2018, it might make a whole heck of a lot of sense to make this number 3.3 this year, because then the earnings are going to hit the next year when that accounting treatment gets reversed and your stock gets a little pop. Or there's something else you could do. If you really wanted to line your pocket, what you'd do is you'd pump this number up, you'd drive the stock price down, you'd buy a bunch of stock, and then it would reverse the next year. You're like, you can buy as much stock as you want. You know exactly the reason it's going down. You set the number. You have control over that number. So you don't need to worry about lower earnings. You know why they're lower, and you know that the very next year they're going to reverse themselves because you control the accounting. Okay. Adequacy. So we're going to take our estimated additions charged over actual deductions, and that gives us just kind of another lens to view the accounting. So in 2016, we were adequate. We reserved enough to pay for the actual deductions. In 17, we were more than adequate. So when you're more than adequate in 17, what happens in 18? Well, you don't reserve as much. This is the earnings flowing through to the bottom line here. And that's okay, because you had throughout that period, you had a big enough sales returns and allowances account whereby you didn't necessarily have to worry about any charges for that. Okay. So let's take all that and do something with it. And when I say do something with it, let's assume that the little exercise I just took us through where Levi had a 2.8% reserve and they booked it for 3.3. And we say to ourselves, we think that's high. We think management is manipulating the accounting. Or we say to ourselves, that's materially different from GAAP. It's different from generally, not general accounting principles, but the GAAP, where you go to and buy genes, one of their competitors. And we want to put them on an equal plane. So the next step as an analyst is always to recast the financials. Let's take a look at what those financials would have been on a pro forma basis if the numbers were what we think they should be, or if the numbers were what their competitors' numbers are. So we can get apples to apples and look at earnings. So we're gonna do that throughout the semester. You get a lot of homework questions on that, probably get some exam questions on that. It's really pretty simple math. We're gonna take that table we just looked at. We are going to average out the additions charged. So if you average the additions charged divided by gross sales, you get an average of 10.04. And we actually took that by summing the additions for 2016, 2017, 2018, and dividing them by the sum total of the gross sales to get this additions charged to gross sales number. Now, once you have an average number, or whatever, in this example, we're using an average. It doesn't have to be an average. You can say to yourself, I just don't believe that number. I think it should have been higher. Pick a number out of the air. Stress test the financials. When you do that, you're going to take that number and make these adjustments to the financials. So when we restate the income statement, looks like the net sales, in order for that to equate to that 10.4 number we saw on this prior slide, we're going to have to increase net sales by 11,000. In 17, we have to do it by increase by 5. In 18, we have to decrease by 17. Have to adjust the additions, income statement, net income, it all flows through to retained earnings on the bottom side of that chart there. And now you have numbers that you can compare on an apples to apples basis. Zipping right along here because I'm going to run out of time tonight, but I want to touch on as much as possible, including unearned and deferred revenue. Embarrassingly, it took me probably a decade to come to the understanding that unearned and deferred revenue are the same thing. I used to see them used in different places and struggle with the accounting for each. They're identical. Unearned revenue equals deferred revenue. You'll see different authors, you'll see different texts, you'll see different problems, call it unearned. You'll see different authors, texts, problems, call it deferred. It's the same thing. And if that clears up a little bit of confusion for you, hopefully you won't have some of the same troubles that I have. So all deferred revenue is revenues that we have collected that we have not yet earned. So this is part of the confusing aspect of unearned revenue. It's not revenue at all. It's a liability. It shows up on our balance sheet as a liability. Somebody gives us revenue, and now all of a sudden, because we've taken receipt of that revenue, and it's not revenue, it's I should call it cash. Somebody gives us cash. Now all of a sudden, because we've accepted that cash, we are now obligated. We have a liability to deliver a good or to deliver a service in the future. That liability, which is what we owe that good or we owe that service in the future, shows up on our balance sheet as deferred revenue. So don't get confused. Deferred revenue, unearned revenue, it's not revenue at all. It's actually a liability. And it represents an obligation that we have to deliver a good or service at some point in the future. So the example that our authors give us here is with Lowe's companies, and you can see their disclosure on the fine print of this slide. They have service revenue, stored value cards, and extended protection plans that all take the form of deferred revenue. These are all different services, cards, protection plans, whereby they've accepted the cash and promised to do something in the future, but they haven't actually done that thing yet. So until they do, that's going to show up as a liability on their books.
So like for one of those extended protection plans, say it's, 5 years after manufacturer's warranty. So on 5 years and a day, that's when they can then recognize that. The payment that you paid for that
That's a-
service plan.
That's a good question. And I don't know the answer to that question. My suspicion is that it would be dictated by their own unique revenue recognition policy. So and they might be able to do it really over time. So,
Each portion of it is recognized,
well, it'd be like, so
like 5 years.
I
minus 1 year.
would suspect if you're trying to do it the most accurate way possible, you would recognize that deferred revenue over time on a gross manner. So in a gross way, you could recognize it over time with an adjustment for, if you have 100 goods outstanding, only 5 of them are gonna come back and cause you to have to do something with that extended warranty. So you can make another adjustment to that. And the further you get to that 5-year mark, the more confidence that you have in the number that are actually gonna come back. So we do the same thing here in a moment. You're gonna see that we do the same thing with an aging of accounts receivable question. So I don't go there quite yet. This is weird. Our authors talk about foreign currency effects in this chapter. And it just seems like an odd topic to me, but we'll cover it briefly and then we'll cover it. I think it's in module 10. We'll take a deeper dive into the accounting for this. But a lot of you have companies that you're working on analyzing that have operations overseas. I think 3M. Okay, yeah. If you look at the I was just looking at this yesterday. I'll pose it as a question. What percentage of revenues to S&P 500 companies come from overseas? $90. That's high. 30%. That's closer. That's a little low, 40%. So these are all, they're all US listed companies. So, yeah, but then you're working with like Apple and American Express and some of the largest global banks in the world. And you have, some other larger manufacturers like 3M. So on the whole, about 40% of their revenues come from overseas, which is very, very close to, no, I take that back. I was gonna say it's close to the global GDP, but I don't think that's right. I think global GDP is closer to, I think the United States accounts for about 1/3 of global GDP. Anybody else? We'll go with that. Yeah, I think the US is about 1/3. So if you really wanted global exposure in the proportion to this global GDP, you'd have to go someplace other than just the S&P 500. Point I was trying to make is it was higher than I thought it was when I stumbled onto the data point. So if you want global exposure in your portfolio at the cheapest cost, just buy the S&P 500 index fund, and you're going to get exposure to a lot of foreign currencies without having to go and buy in a separately denominated currency, and you're going to get all of the rules and protections afforded by the SEC, which is a good thing because it gives us as investors visibility into the accounting, and it creates a watchdog effect, so to speak, because you multiply this classroom by another 10,000 across the country, and we turn out some pretty good analysts that hold management teams accountable and generally make for a pretty healthy place to invest on a global basis. Okay, foreign currency, let's talk about this real quick. Know that if you're 3M and you have 50% of your revenues coming from overseas, you collect euros, you collect yen, you collect yuan. That's what sits in your bank account. But at some point in the year, you have to produce a piece of paper that has balance sheet written across it, so that we can all analyze it. Well, that can only be in one currency. So you don't take all those euro, yuan, yen, renminbi, and exchange them at the end of the year. You still own the foreign currency. You just have to translate it so you can produce a piece of paper that says balance sheet at the top of it, and it's all denominated in US dollars. But that doesn't mean you actually own the US dollars. It just means you're creating a piece of paper. Well, when you do that, you subject yourself to translation gains and losses. So if you collect that revenue throughout the year, what happens at the end of the year? Anybody know what's going on with the currency markets these days? Anybody know? So take the dollar to the pound, for example.
So, recently decreasing, bonds decreasing.
Yeah, that's about right. I had it in my mind that the dollar was up about 30% relative to the pound just this year. Hit an all-time, not an all-time high, but it hasn't been at this level since 1985.
Around 1.06, I think.
Oh, okay, that's the exchange rate. It's almost at parity, which is really remarkable. What that means is it's time to go to London. So I told my wife this week, we were sitting on the couch, I said, we're getting a 30% discount on our trip because the dollar has risen so much against the pound. And she said, woo-hoo, I'm going to Harrods. So that'll be fun. If you're 3M and you're doing all this business over in Great Britain, you're collecting all these foreign denominated currencies. You have all these pounds. And then at the end of the year gets here, and you look back and you see that the dollar has appreciated by 30%, and you got to translate all that business. Well, if you did $1 million worth of business or £1 million worth of business, now you're translating that, and it looks like you just took a 30% loss because you got to take all those earnings, you got to take all those retained earnings and translate them back into a more expensive currency. So be mindful of that. And we're not looking at the accounting for that in this chapter, because there's a special way that we account for that. I'm sure some of you have run into it before. It's called comprehensive income. We don't even put those fluctuations in net income. They flow through to another line item on the income statement that we segregate called comprehensive income. And accountants do that because there are some things about the world of accounting that are so volatile, we want to segregate them all. Because if we put them in net income, if we put them in the regular income statement, it creates unusable financials.
Is there a way to like companies to like put the currency back into like move from pounds to dollars in like a shorter time frame, or is that kind of at one particular point at the end of the year or something like that?
Yeah, they can do it anytime they want. Most companies that have ongoing operations in foreign jurisdictions, they just leave those foreign jurisdictions to operate in that currency. Now, if they wanted to take a position and speculate or hedge those cash flows, they could do it through the futures market and the forwards market, and they could contract with a large New York bank, and they could say, Goldman Sachs, we don't want any exposure to a rising dollar this year. So if 3M or Levi's had done that, they would enter into a forward contract. And at the end of the year, that forward contract would have appreciated in lockstep with the depreciation in the currency. So they'd have a big translation loss. It's a translation gain or loss on the conversion of that currency. They'd have a big translation loss on that currency, which would be 100% offset by the hedge they entered into with Goldman or Deutsche Bank or whoever. And then that's module 11. We'll get into the accounting for those swaps and forward derivatives. And
Just get listed somewhere else besides the comprehensive one.
if it's an operating hedge, they flow through to net income. So the way what's your name? Thomas. So Thomas, if it's the way you described, it flows through to net income. That's called a hedge. If it's speculation and you don't have an offsetting position, then it'll flow through to the other comprehensive. Okay. Let's talk about accounts receivable. So we talked about sales a moment ago. And we talked about the difference between gross sales and net sales, because we're gonna have some sales returns and allowances. Now we're gonna talk about accounts receivable, and we need to talk about gross accounts receivable and net accounts receivable, because not all of those accounts receivable are gonna get hit. When we sell something on credit, I'll just use myself as an example. Every once in a while, we're gonna stumble across a Vern Cushenberry and come to find out that Vern Cushenberry is a deadbeat and he is not gonna pay you back. So what happens when we stumble across this example? Well, any company with any operating history, just like Levi's, they know that a percentage of the credit sales that they make on account ultimately won't get paid back. So maybe that's 5%, maybe that's 10%, maybe that's 20%, depending upon your policies, because some companies are more generous with their credit sales than other companies. We need to make an adjustment to that. So just like we've made an adjustment to sales, we're gonna make an adjustment to accounts receivable. And there are different methodologies that we can use to create and estimate that amount. Here's one methodology that our authors give us on slide number 37 here. We use an aging of accounts receivable schedule. This is very, very common. We'll look at our sales that are current. Currently, we have $50,000 worth of receivables on our balance sheet. Of current receivables. And we know from experience that 2% of those sales are going to go bad. And therefore, we want to make an adjustment to our accounts receivable in the amount of $1,000. We also know that there are $30,000 worth of receivables owed to us that are somewhere between 1 and 60 days past due. Now, once a receivable gets past due, the likelihood that we're not going to get paid back starts to creep up. So from experience, we know that 3% of those are ultimately uncollectible. So for that tranche, we're going to book an adjustment of $900. $15,000 worth of receivables are owed to us that are 61 to 90 days past due. We know 4% of those go bad. So we're going to book an additional $600. And then $5,000 worth of receivables are over 90 days past due. And we know 8% of those are going to go bad. So our estimated uncollectible accounts is $2,900. And you see accounts receivable reported on your balance sheet, much like our authors show here, trade accounts receivable less allowance for doubtful accounts, and then you'll see the individual numbers associated with the allowance for doubtful accounts line. And it will be no surprise to you to hear me say that because we're walking through a process of estimation, this is another one of those places where it's very, very easy to find the penny. And when I say find the penny, I'm referring to Wall Street targeting their earnings per share number. And every analyst on Wall Street plays this game where they'll sit down quarterly and they'll try to guess or forecast what 3M's earnings are going to be. And Bank of America and Goldman Sachs and Merrill Lynch, and they all have analysts that get paid very, very well to come up with these estimates. So if you're a management team, you know that you're going to get penalized if you don't hit these estimates. So if you're expected to make $2.31 and it's September 29th, and you have to report earnings tomorrow because the quarter is about to close, and your CFO comes to you and says, well, we did pretty good this quarter. We're going to come in at $2.30 worth of earnings. Well, you need to find a penny. This is a pretty good place to find a penny. Everywhere in the accounting where we get to make the estimate or choose between one treatment or another treatment, we can play a little game of find a penny. And then on the result is right. Okay, I want to talk about these ratios. These ratios are, they're just the most helpful spot that we can go to when we're analyzing a business. They help us identify trends, they help us identify pink flags, and we're going to look at accounts receivable turnover, which is a pretty simple ratio, sales divided by accounts receivable. Tells us what percentage of sales are coming from accounts receivable. We want to see that pretty constant over time is what I would expect. If it starts to tick up, you need to ask yourself questions like, why is this company willing to accept more sales on account? What does that say about the quality of their sales? Is that an indication that more of those accounts receivable might be bad debts? Is the company having to do something that they haven't historically had to do to reach the same sales figures? Days sales outstanding is the second formula on that page. We're going to look at our accounts receivable turnover in the denominator, and we're going to take that into 365 days in a year to get 55.3 days. That looks at how long it's taking us to collect your typical sale on credit. So 55.3 days for a company like Pfizer. We looked at this ratio a couple weeks ago. I made some comments about how powerful Apple is when you're looking at their cash conversion cycle. They actually bring in the cash first and pay all their original equipment manufacturers way down the line. So I don't have a frame of reference for Pfizer about whether that's high or whether that's not high. But if you look at it across time, it's going to give you some insights. These numbers might be a little harder to find. Accounts receivable turnover across time. You can see here that Pfizer, moving from, I guess it's right to left, they went from 5.6 to 6.4 to 6.6. So their accounts receivable turnover is it's going up over time, which is a sign of health. So they're collecting those accounts receivables. And a lot of times you'll see that flow across many, many companies in a manner that's consistent with the underlying economy. You know, have you heard anybody say we're either in a recession or getting ready to go into a recession? No, okay. No, I hear it all day long, every day. So if that's true, then people are going to start extending their payments, and that's going to show up in the accounts receivable turnover numbers for most of the companies that do business with, you know, Joe and Jill Sixpack across the country. So, you know, first look for idiosyncratic factors that might be driving the changes in some of those ratios that are specific to the companies that you're doing research on. And then look for broader global geopolitical trends that might be impacting some of those forces. And that's a little bit of a common sense question. While we're in a recession, of course, you would expect the data to be trending a certain way. Put on most of these points. So slide number 46 talks about analyst adjustments again, with all of these ratios. Once we come to some conclusion about the reasonableness of what we're looking at, we may or may not want to recast the financial statements. So our authors give us an example of Pfizer here, where we look at the allowance for doubtful accounts divided by the accounts receivable gross. The average over the last 3 years has been 6.6%. So if we wanted to apply that average and recast the financial statements, you'd get an as reported line here, gross accounts, and an adjusted line here, which is adjusted for doubtful accounts using the average percent. And then you take those numbers and flow them all the way through the income statement, and you would have a recasted income statement and or balance sheet, as the case may be. Okay, learning objective number 6, I'm going to move on to analyzing operating expenses and discontinued operations. This is a great learning objective. This is one that you star for even after this class because it's so useful. It gives you a breakdown of the terminology that you should expect to see for most income statements. I think it might touch on balance sheets here too, but generally speaking, when we're looking at a manufacturing company, we're going to have sales and then cost of sales, selling, information, administrative expense, research and development, amortization. These are common roll-ups. When I say a roll-up, you may have 20 or 30 individual expense and or revenue items underneath each one of these headings. But the major headings are what drive the income statement and what we can use to drive a lot of the ratio analysis to give us insights into common size and comparable peer group analysis. Then you may also see restructuring charges, which star restructuring charges, because that's another one of those line items that management teams can manipulate. Whenever you see restructuring charges, you're going to see an estimate of the total expenses associated with a business unit that management has deemed to be no longer relevant, and therefore they're getting rid of it. And there'll be a lot of estimates in that line item that says restructuring charges. Provision for taxes, discontinued operations. Discontinued operations are always presented net of tax. I'll show you how that manifests here in a moment. Income attributable to non-controlling interest. Many of you will see that on your income statements. I mentioned this a time or two ago in class. That shows up when we have a company that owns another company, but it's not fully owned. So Berkshire Hathaway owns 99% of one of its subsidiaries. There's still 1% of it out there that's owned by somebody else. That somebody else is called a minority shareholder, and they're entitled to some of the income that shows up and runs through that business. So we're going to account for that in a line item that says income attributable to non-controlling interest. Now, when we do any of our analyses, and we try to later in the semester put a value on the shares of our businesses, we're going to do it at the parent company level. What I mean by that is we don't care about it. We're going to subtract it out. We're common shareholders. We're not minority shareholders. We don't care about what's relevant to them, but we have to account for it. So R&D costs are expense as incurred. Nothing unusual about R&D costs, except for they can inform our viewpoint as an analyst. If you look at a company like Pfizer, which is a pharmaceutical company, if they start to skimp on their R&D, well, that's a little red flag for future revenues. That's the driver of what's going to support their whole business 5 years from today, 10 years from today, 20 years from today. That R&D is critical. It's a critical component of their business. Now, alternatively, they could take those R&D dollars and invest them into mergers and acquisitions. which is just R&D by a different name. Instead of developing it internally, you're buying the R&D of another firm. So that's mergers and acquisitions. Kind of need to be mindful of that. But in the absence of another strategy, if you were to see R&D dollars begin to decline, that should be a little bit of a red flag. And it's a very easy place to play a game of find the penny, because in any single year, it's easy to dial back your R&D. Just don't spend the money. Those cost savings drop straight to the bottom line. It's a terrible long-term strategy, but as a short-term strategy, it's a great place to find some earnings. Our authors give us a little bit of perspective on how different companies invest in R&D. See semiconductors there on the far right. If you have a company in one of those industries, put some work into your R&D. Understand how they've been spending those funds over time, and understand how that positions them against their competition, which is this chart here. So you can see Pfizer benchmarked against AbbVie, GlaxoSmithKline, Eli Lilly, J&J. This is R&D as a percent of sales. Pfizer has been just short of 15% the last 3 years. And that puts them ahead of Bayer, ahead of Glaxo, way below Eli Lilly. Look at Eli Lilly, 25, 23, 21. And then Novartis, Merck, AbbVie, all around 17. So I mentioned M&A a moment ago because Pfizer has historically been strong in M&A. So if you know that, then this data that positions them as spending less in R&D versus some of their competitors becomes a little less worrying.
The DB, LSE, and SWX, those are the different exchanges that those are traded on.
Yeah. London, Germany, New York. I don't know what SWS is. I'm guessing Swiss. They all have American depository receipts, which allow them to trade in the United States as well. And okay, discontinued operations. There's 2 points here I wanted to make on discontinued operations. Firstly is that they're segregated off from continuing operations, and you're going to see all of the major roll-ups that we just looked at a moment ago presented on the income statement. Then you're going to see income from continuing operations. Then you're going to see a whole section devoted to discontinued operations. That's typical. That's shown here, where discontinued operations are presented as income net of tax, any gain or loss on the disposal of those operations, which is also presented net of tax. And then you have a total for that discontinued operations line. One of the ways that sometimes you see this manipulated. This isn't necessarily a game of find the penny, but you'll see management teams job owning Wall Street analysts, try to get them to focus their attention on what they think is relevant. And what they're trying to get them to focus on are the ongoing operations of the business. So take a bad business unit, take a bad deal. We launched some sales operation over in Australia and it went really, really bad. Any garbage, just anything that really didn't go well. You'll see management teams throw that in discontinued operations. What? Ford
In India.
Okay, Ford India. Discontinued. And the message to Wall Street is, don't worry about that. It was a one-time event. It's not important to the ongoing future operations of our company. And you should focus on the operations line. And management teams are very, very good at telling this story. And they have a tendency to do exactly that. I can't count how many times I've seen management teams tell Wall Street that some business unit that's just absolutely terrible, doesn't matter, And they won't ding them for it. Okay, maybe you do that once, maybe you do that twice. And I believe you. But a third time, a fourth time, a fifth time, starts to send up a little pink flag, to me anyway, as an analyst. So what I like to do is I like to look at these discontinued operations over time. And if a management team or business has a consistent track record of putting things in discontinued operations, to me, that's nothing more than a history of bad decision making. You shouldn't have to discontinue operations unless they represent prior mistakes. So somewhere in that extended history of bad decisions, there needs to be a big time management change. And if you haven't seen that, then you should think about who's at the helm here. You know, who's steering this ship for investors? Who's acting on their behalf? So take a look at those discontinued operations line items and see how far they go back and what their magnitude is and whether or not you can make any sense out of them. And I did not get to interpret pro forma and non-GAAP disclosures. I think that's one you can easily handle on your own. That is module number 5, y'all. So good luck on your exams this week. Let me know if you have any questions. I will be out of the country and non-responsive, but let me know anyway. Where you going? I'm going to London.
Oh, actually,
Yeah,
okay.
I'm going to run the marathon next Sunday.
Oh, wow.
Looking forward to it. So, what's that? That's cool. Yeah, I hope so. All right, thanks, gang. Appreciate your time.